All right, and I need you to lock in for the next few minutes. What I'm about to walk you through is not a prediction, not a theory, and not another headline dressed up as analysis. This is about a sequence of actions the Federal Reserve and the United States Treasury quietly executed over the last several weeks that most depositors have no idea happened. And what those actions tell us about where your savings actually stand right now. On March 12, 2025, the Federal Reserve's Bank Term Funding Program officially expired. That facility had been quietly backstopping over $165 billion in bank borrowing since the Silicon Valley Bank collapse in March 2023. No emergency replacement was announced. No press conference. No guidance. It was simply allowed to die. And the institutions that had been leaning on it were left to find other sources of liquidity in a rate environment where that liquidity is not cheap. That single event did not make the front page of the Wall Street Journal. It did not trend on financial Twitter, but inside the balance sheets of over 4,000 regional and community banks across the United States, it created a pressure that has been building ever since. Quietly. Mechanically. Exactly the way these things always start. Here's what this is not. This is not a bank run. It is not a market crash. It is not a panic. What it is a system reacting to the removal of a support mechanism it had become structurally dependent on, and that reaction is now showing up in the data in ways that are impossible to ignore if you know where to look. I have been watching these sequences for a long time. The names change. The triggering events change. But the mechanics, the order of operations, the pressure points, they are always the same. What changes is whether the people sitting on the other side of these institutions understand what is happening before the window closes. Most do not. That is not cynicism. That is the historical record. So let me walk you through exactly what is happening, why it was forced, what it means for the $9.6 trillion sitting in United States bank deposits right now, and why the phrase "no way out" is not rhetoric. It is a mechanical description of the position the Federal Reserve is currently in. The story begins not in 2025, but in March 2022, when the Federal Reserve began its most aggressive rate hiking cycle since Paul Volcker broke inflation in the early 1980s. Between March 2022 and July 2023, the Fed raised the federal funds rate from effectively 0 to 5.25 to 5.5%. 11 rate hikes in 17 months. The fastest tightening cycle in 4 decades. Now here is the mechanism that most people missed entirely. When the Fed raises rates that aggressively, the value of existing fixed income assets, meaning bonds and mortgage-backed securities held on bank balance sheets, collapses in real time. This is basic bond math. When rates go up, bond prices go down, and the banks had loaded up on long-duration treasuries and agency securities during the zero-rate era because they were considered safe and they paid slightly more than holding cash. By the end of 2022, the unrealized losses on the securities portfolios of FDIC-insured banks had reached $620 billion. That number was not a projection. It was published by the FDIC in their quarterly banking profile. $620 billion in paper losses sitting on the balance sheets of institutions holding your deposits. The banks were not insolvent on paper because accounting rules allowed them to classify these securities as held to maturity, meaning they did not have to mark them to market. But the losses were real. The pressure was real. And the risk was real. Silicon Valley Bank made the mistake of making that risk visible. When they announced in March 2023 that they needed to sell $21 billion of their securities portfolio at a $1.8 billion loss to raise liquidity, the market understood immediately that every other bank facing the same rate environment was sitting on the same problem. The difference was just the size and the visibility. The run that followed was the fastest bank run in history. $42 billion left SVB in a single day. The bank was closed within 48 hours. What the Federal Reserve did next was decisive but also revealing. They launched the Bank Term Funding Program, a facility that allowed banks to pledge their underwater securities as collateral at par, meaning at face value, not market value, in exchange for one-year loans at the overnight rate. It was a quiet bailout. It told the market that the Fed understood the problem was systemic, not isolated to SVB, and it put a floor under the bleeding. But here's what that facility also revealed. The Fed had essentially acknowledged that the rate hiking cycle had created a structural solvency risk across the banking system. Not theoretical, structural, and the BTFP was the mechanism holding that structure together. When the BTFP expired on March 12, 2025, peak borrowings under the program had reached $165 billion. The Fed did not renew it, and they did not replace it with anything equivalent. What they said was that conditions had normalized sufficiently, and that the existing discount window was adequate for any remaining needs. What they did not say is that the discount window carries a stigma, requires different collateral standards, and that banks using it are immediately visible to market participants as institutions under stress. In other words, the safety net was removed and replaced with a facility that institutions are structurally reluctant to use publicly. Now pay close attention to what happened next, because this is where the sequence becomes what analysts call path dependent. Once the BTFP closed, banks that had been using it to paper over their unrealized losses had to find alternative strategies. Some rotated into shorter duration assets. Some quietly raised deposit rates to retain funding. Some began tightening lending standards to conserve capital. All of these actions are individually rational. Collectively, they create a credit contraction. And a credit contraction in an economy carrying $35.7 trillion in federal debt and $17.7 trillion in household debt does not resolve quietly. The Federal Reserve knows this. The Treasury knows this. And the data from the first quarter of 2025 makes it explicit. Total bank credit in the United States contracted in real terms for the third consecutive quarter. The last time that happened consecutively was 2009 and 2010, in the immediate aftermath of the financial crisis. Let me give you the specific numbers because specificity is what separates analysis from noise. According to Federal Reserve H8 data, total loans and leases at commercial banks peaked in October 2023 and have been contracting or stagnating on a real basis since. Commercial and industrial loan growth, which tracks business borrowing for operations and investment, turned negative in the fourth quarter of 2024. Consumer credit growth, excluding auto and student loans, which tracks real household financial health, decelerated to the lowest rate since 2011. And commercial real estate loan delinquency rates at banks under $10 billion in assets crossed 4.1% in the first quarter of 2025, the highest level since 2013. Each of these data points in isolation is a warning. Together, they describe a system that is quietly seizing, not dramatically, not with headlines, the way a hydraulic system seizes when the fluid pressure drops below the operating threshold. Everything continues to function, but the tolerances are gone. Now let me introduce the piece of this that most people do not understand, and this is where the phrase "your savings are frozen" takes on a very specific meaning. Under the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in 2010 and specifically under Title II, the FDIC has the authority to place a failing, systemically important financial institution into a process called Orderly Liquidation Authority. Under this process, the FDIC becomes receiver. Shareholders are wiped out. Certain creditors take haircuts, and uninsured deposits, meaning any dollar above the $250,000 FDIC insurance limit, are subject to conversion into equity in a bridge institution, not returned as cash, converted into stock in a restructured entity that may have no market value. This is not a hypothetical legal provision. It is the active resolution framework for every bank in the United States above a certain asset threshold. The Financial Stability Board, which coordinates resolution policy for the G20, calls this bail-in. The FDIC calls it Orderly Liquidation Authority. The Cyprus government in 2013 called it a stability measure. The depositors who lost up to 47.5% of their balances above 100,000 euros called it something else entirely. The reason this matters right now is not that every bank is about to fail. The reason it matters is that the conditions which make that framework relevant, namely unrealized losses on securities portfolios, tightening credit availability, and rising loan delinquencies in commercial real estate, are all present simultaneously in the current environment. And the backstop that was suppressing the pressure, the BTFP, no longer exists. Here is the part of the sequence that should make you genuinely uncomfortable. The Federal Reserve is now caught between two outcomes, neither of which is acceptable. Option one is to hold rates where they are or raise them further to demonstrate inflation credibility. This protects the currency and maintains international confidence in dollar assets. But it also continues to erode bank balance sheets through unrealized losses, pressures commercial real estate refinancing across the $1.5 trillion maturity wall hitting in 2026, and slows the economy to the point where loan defaults accelerate faster than the system can absorb them. Option two is to cut rates aggressively and re-inject liquidity into the system. This would relieve the balance sheet pressure and reduce refinancing stress. But it would also re-accelerate inflation in an environment where shelter inflation, services inflation, and wage inflation have all proven structurally resistant to the rate increases already delivered. Cutting into a re-accelerating inflation environment destroys the credibility of the central bank. And once that credibility is gone, the consequences are not measured in quarters. They are measured in decades. The Fed chose a third path, which is to do neither decisively, hold rates longer than the market expected, allow the data to guide them, and intervene selectively through liquidity facilities when specific institutions come under stress. This is the strategy. It is also the definition of no way out. You cannot normalize monetary policy without breaking something, and you cannot stimulate without reigniting the inflation that required tightening in the first place. You are managing a pressure system that has no safe release valve. Let me show you where this has played out before, because the current configuration is not without historical precedent. In Japan in 1991, the Bank of Japan raised interest rates aggressively to combat asset price inflation in real estate and equities. The Nikkei had tripled in 5 years. Commercial land prices in Tokyo had increased by factors that made Manhattan look conservative. The BOJ hiked, the bubble collapsed, and the Japanese banking system entered a period of sustained stress that lasted not months, but decades. The Nikkei did not return to its 1989 peak for 34 years. Japanese banks spent the entire 1990s in a condition that analysts called zombie lending, extending credit to insolvent borrowers to avoid recognizing losses. Sound familiar? Extend and pretend is not a new concept. It is the rational institutional response to an environment where recognizing losses triggers consequences that management cannot survive. The parallel in the United States today is the commercial real estate portfolio management happening at regional banks right now. According to data from TREP, a commercial real estate analytics firm, office loan delinquency rates in the United States crossed 10.4% in the first quarter of 2025. That is higher than the peak delinquency rate for office loans during the 2008 financial crisis. The peak in 2010 was 9.5%. We are already past that level, and the maturity wall, the $1.5 trillion in CRE debt coming due through 2026, has not yet fully arrived. The second historical parallel is the savings and loan crisis of the 1980s and early 1990s. Between 1986 and 1995, 1,043 savings and loan institutions failed in the United States. The total cost to taxpayers was $132 billion, which in current dollar terms exceeds $300 billion. The root cause was structurally identical to what we are seeing today. Institutions had borrowed short-term from depositors at variable rates and lent long-term into fixed-rate mortgages and real estate development loans. When interest rates rose sharply, their funding costs exceeded their asset yields and they became technically insolvent. The regulatory response was to allow institutions to continue operating under the fiction of solvency while hoping the problem resolved itself. It did not. The losses grew larger every year they were deferred. By the time the government was forced to intervene at scale, the cost had multiplied several times from where it would have been had early action been taken. The FDIC's Deposit Insurance Fund currently holds approximately $121 billion against $9.6 trillion in total insured deposits. That is an insurance ratio of approximately 1.26%. The FDIC's statutory target is 1.35%. The fund was below target as recently as 2023 following the Silicon Valley Bank and Signature Bank resolutions and was rebuilt through special assessments levied on large banks. If a cluster of regional bank failures were to occur simultaneously, the arithmetic of that fund becomes very uncomfortable very quickly. This is not a secret. The FDIC publishes it, but very few depositors have ever read an FDIC quarterly banking profile. Now let me explain specifically what the phrase "your savings are frozen" means in the context of an FDIC resolution. When a bank is placed into receivership, either through a standard closure process or through orderly liquidation authority for a systemically important institution, there is a period during which depositors cannot access their funds. For standard FDIC closures, this has historically been resolved within 1 to 3 business days for insured deposits. Uninsured deposits, those above the $250,000 limit, are treated as unsecured claims against the receivership estate. Their recovery depends on the value of the assets in the failed institution's portfolio. In the Silicon Valley Bank resolution, uninsured depositors were ultimately made whole because the FDIC determined that systemic risk warranted an exception. But the FDIC is not legally required to make that determination, and in a scenario where multiple institutions are failing simultaneously, the systemic risk exception becomes harder to apply uniformly without exhausting the insurance fund entirely. The key word in all of this is conditional. Your deposit is a liability of the bank. It is not your property held in custody. When you deposit money in a bank, you become an unsecured creditor of that institution. The bank owns the money. You own a claim. In normal times, that distinction is irrelevant. The bank pays you back on demand. But in resolution, that distinction is everything. A secured creditor recovers first. An unsecured creditor, which is what a depositor is, recovers from whatever is left. The Basel III capital framework, which was implemented globally after 2010 and tightened through the Basel III endgame rules currently being finalized in the United States, requires banks to maintain total loss absorbing capacity, or TLAC. This is a buffer of equity, bonds, and certain liabilities that can be bailed in, meaning written down or converted to equity in a resolution. Under the Financial Stability Board's TLAC standards, uninsured deposits at systemically important banks are explicitly included in the liability structure eligible for bail-in. Your deposit above the insurance limit is, in the language of the regulatory framework, a loss-absorbing liability. That is what you are holding, not cash. A loss-absorbing liability. Let me be precise about something here, because precision matters and the distinction between stress and failure is not academic. The United States banking system is not failing today. The largest institutions, JP Morgan, Bank of America, Wells Fargo, are well capitalized by every regulatory measure and have diverse enough business models to absorb the current commercial real estate stress without catastrophic outcomes. The risk is concentrated in the roughly 4,500 community and regional banks with assets under $100 billion that hold disproportionate concentrations of commercial real estate loans and that do not have the revenue diversification to offset portfolio losses through fee income and trading revenue. The St. Louis Federal Reserve's FRED database shows that banks with assets between $1 billion and $10 billion currently have average commercial real estate concentrations equivalent to 3.8 times their Tier 1 capital. The guidance threshold at which regulators consider concentration risk elevated is 3 times. A significant portion of the community banking system is already operating above the threshold that historically precedes regulatory scrutiny and forced balance sheet restructuring. This is the pressure building inside the system right now. It is not uniform. It is concentrated. But concentrated pressure in a financial system does not stay contained. It transmits through interbank lending markets, through correspondent banking relationships, through the municipal bond markets that community banks are significant buyers of, and through the confidence mechanism, which is the most fragile and most important component of any banking system. Now let me address the question that every rational person watching this should be asking. If the Fed cannot raise rates without breaking the banking system and cannot cut rates without reigniting inflation, and the backstop facility has expired, what actually happens next? The answer is that the sequence of events is already in motion, and it is mechanical, not discretionary, at this point. Step 1 is already underway. Banks tighten lending standards to preserve capital. This is documented in the Federal Reserve's Senior Loan Officer Opinion Survey, which showed in the first quarter of 2025 that a net positive percentage of banks were tightening standards on commercial and industrial loans, commercial real estate loans, and consumer loans simultaneously. The last time all 3 categories tightened simultaneously at this scale was the fourth quarter of 2008. Step 2 follows directly. Tighter lending standards reduce credit availability, which slows business investment, slows consumer spending, and increases the probability of corporate defaults. The bankruptcy data confirms this is already occurring. Total commercial bankruptcy filings in the United States for calendar year 2025 are tracking at the highest level since 2010. Chapter 11, filings for businesses with liabilities exceeding $10 million are up 22% year over year. Step 3 is the feedback loop. As corporate defaults rise, the loan portfolios of the banks that finance those businesses deteriorate. Charge-off rates, the percentage of loans banks write off as unrecoverable, began rising in consumer credit in late 2023 and have been spreading to commercial credit through 2024 and 2025. Each dollar charged off reduces bank capital directly. Reduced capital requires either equity issuance, which dilutes existing shareholders, or balance sheet contraction, which means fewer loans, which reinforces step 1. Step 4 is where the system becomes externally visible. Unrealized losses, rising delinquencies, falling capital ratios. These eventually show up in bank earnings reports. When they show up in earnings, they show up in stock prices. When they show up in stock prices, they show up in depositor psychology. And depositor psychology, as March 2023 proved definitively, can move $42 billion in a single day. The Federal Reserve's response to Step 4 will be the defining moment of this cycle. If they respond with a new liquidity facility, they confirm that the problem is systemic and that the rate hiking cycle broke more than they admitted. If they allow individual institutions to fail in an orderly way, they risk the contagion that orderly processes are supposed to prevent. If they cut rates preemptively, they invite the inflation reacceleration that destroys the credibility of everything they did between 2022 and 2024. There is no clean option. This is what no way out means in practice. The historical context here is the period between August and October 2008. Bear Stearns had been resolved in March. Fannie Mae and Freddie Mac had been placed into conservatorship in September. The pressure had been building for 18 months. And still, when Lehman Brothers filed for Chapter 11 on September 15th, the market response was treated as a surprise. It was not a surprise. Every mechanism that produced that outcome was visible in the data for months prior. What was missing was the recognition that the system had already passed the point at which individual interventions could contain a sequential cascade. We are not at September 2008. To be clear, the institutions involved are different. The regulatory framework is more sophisticated. The Fed has more tools today than it did then. But the structural condition, an overleveraged system facing a sustained rise in the cost of money with insufficient capital to absorb the transition, is analogous in the ways that matter. Now, I want to talk about what this means for the $9.6 trillion in deposits sitting in the American banking system right now, and more specifically, what it means for the portion of that total that sits above the FDIC insurance limit. According to FDIC data from the 2024 annual report, approximately 40% of total deposits by dollar value are uninsured. That is roughly $3.8 trillion sitting in accounts above the $250,000 threshold at FDIC-insured institutions. These are not hedge funds and sovereign wealth funds. These are small business payroll accounts. They are corporate treasury operations. They are the working capital of the businesses that employ the people who also have deposits in those same banks. The question is not whether those deposits will be accessed tomorrow. In all probability, they will. The question is under what conditions, in what sequence of events those deposits cease to be unconditional claims on cash and become contingent recoveries in a resolution process. And the honest answer is that the conditions under which that transition occurs are not theoretical. They are documented in law, they have occurred in practice in Cyprus in 2013, and in the bail-in of Banca Etruria in Italy in 2015, and they are embedded in the resolution framework of every G20 jurisdiction by design. This is what the competitor narrative in mainstream financial media consistently fails to connect. The bail-in framework is not a distant policy option. It is the active resolution mechanism. It was designed specifically because the political will for taxpayer-funded bailouts evaporated after 2008. The public demanded that banks and their creditors, including depositors above the insurance limit, bear the cost of failure rather than taxpayers. The legislation that resulted from that demand is the legislation that currently governs the fate of $3.8 trillion in uninsured deposits. Understanding this is not doom scrolling, it is reading the terms and conditions of the account you hold. Most people have never read those terms. And in a functioning, growing, low-stress financial environment, that is a perfectly rational choice. We may not be in that environment for much longer, so let me be direct about what the three positions look like for someone who understands this sequence and wants to act before the system makes the decision for them. The first position is structural. It is not a trade. It is an acknowledgement that the insurance limit exists for a reason, and that operating above it in a single institution without understanding the bail-in framework is an uncompensated risk. Spreading deposits across institutions, moving uninsured balances into Treasury direct accounts which carry zero bank counterparty risk, or structuring operating capital through money market funds backed by U.S. government securities directly, eliminates the bail-in exposure without eliminating access to liquidity. This is not exotic. This is what institutional Treasury operations have been doing quietly since 2023. The second position is the monetary hedge. Physical gold is not an investment in the traditional sense. It is a claim on purchasing power that exists outside the liability structure of any bank. It cannot be bailed in. It cannot be devalued by a central bank decision. It cannot be frozen over a weekend during a resolution process. Central banks globally purchased 1,037 tons of gold in 2023 and 1,045 tons in 2024, according to World Gold Council data. 2 consecutive record years. China's People's Bank of China added to reserves for 18 consecutive months through mid-2024. India purchased 72 tons in fiscal year 2024. Poland, the Czech Republic, Singapore, and Qatar all disclosed significant reserve increases. These are not retail investors reacting to fear. These are the institutions that design and operate the monetary system, and they are moving into gold at a pace and a persistence that has no precedent in the post-Bretton Woods era. When the architects of the system are accumulating the one asset that exists outside the system, the signal is worth taking seriously. Silver presents a different but related asymmetry. The Silver Institute's 2025 World Silver Survey documented a physical supply deficit of 215 million ounces in 2024, the fourth consecutive year of structural deficit. Industrial demand, driven by photovoltaic solar manufacturing, electric vehicle power management systems, and defense electronics, is consuming silver faster than mining and recycling can replace it. Above-ground investment-grade silver inventories registered in LBMA and COMEX vaults have declined by approximately 35% since their 2021 peak. The ratio of paper silver contracts outstanding to registered physical silver available for delivery has reached levels that historically have preceded significant price dislocations. These are not narrative claims. They are inventory and flow data available in public filings. The third position is timeline awareness. The $1.5 trillion commercial real estate maturity wall does not arrive uniformly. It arrives in waves through 2025 and 2026, with the largest concentration of maturities occurring in the second and third quarters of 2026. The banks holding those loans have until those dates to find solutions. The options are refinancing at current rates, which destroys borrower cash flows, loan extensions with additional equity requirements which most borrowers cannot meet, or transfer of assets to the FDIC or distressed buyers at significant discounts. The timeline from recognized stress to visible resolution in a credit cycle of this type historically runs 18 to 36 months from the point at which delinquency rates inflect upward. Commercial real estate delinquencies inflected in the third quarter of 2023. That places the peak pressure point somewhere in 2025 to 2026. We are inside that window right now. What happens next is not fully determined. It never is at this stage of a cycle. What is known is this: the BTFP is gone. The unrealized losses are still on bank balance sheets. The commercial real estate maturity wall is arriving. The credit contraction is documented and accelerating. The bail-in framework is law, and the Federal Reserve has no clean exit from the position it is currently in. What is unknown is which specific institution triggers the next visible episode of stress, whether the Fed creates a new backstop facility before or after that trigger event, and whether the political environment permits another round of extraordinary intervention without the public scrutiny that accompanies it this time. Those are sequencing questions. They matter for timing. They do not change the structural condition. The viewer who watches this video and thinks I need to wait for more confirmation before I act is making the same calculation that every depositor in every banking crisis has made at this stage of the sequence. The confirmation, when it arrives quickly, and the window between confirmation and closed exits is measured in hours, not weeks. The SVB timeline from announcement to closure was 40 hours. The IndyMac closure in 2008 took 72 hours from the OTS announcement to the FDIC assuming control. These are not slow-moving events once they become externally visible. They are fast. The preparation is not about predicting the precise moment. It is about understanding the mechanism well enough to act before the mechanism forces the outcome. That window is still open. The data tells you it is narrowing. What you do with that information is the only variable left that you control. Stay locked in. Because this is not the end of the sequence. It is the middle of it, and the next update will matter